Are you ready to unlock the small business tax secrets vault? In this video, we're not simply talking deductions and credits. We are decoding the blueprint to skyrocket your tax savings so you can keep more of your hard-earned money. Now, these tips aren't your everyday run-of-the-mill tax advice. They truly have the power to transform your financial landscape. In fact, one of the secret tips I'll be sharing has saved many of my clients thousands of dollars each tax year. You won't want to miss this one. So brace yourself for our game-changing journey beyond the basics. Now let's get started on the ultimate tax break bonanza. How important is it for you to keep cash in your bank account? Small businesses often operate on tight budgets, and any financial relief through tax breaks can help them reinvest in their operations. This extra capital can be used for hiring, training, purchasing equipment, or expanding the business. Tax breaks can incentivize small businesses to invest in expansion, research and development, and innovation. This in turn contributes to economic growth by creating job opportunities and fostering entrepreneurship. Small businesses face stiff competition from giant corporations. Tax breaks can level the playing field by providing small businesses a competitive advantage, making it easier for them to compete in the market. Small businesses are significant contributors to job creation. By offering tax breaks, governments encourage these businesses to hire more employees, reducing unemployment rates and boosting the economy. They're there for you to grow as a business. Tax breaks can be used to encourage small businesses to comply with specific regulations or adopt environmentally friendly practices. Governments can use tax incentives to nudge businesses toward socially responsible behavior. Tax breaks can allow them to invest in new technologies or adjust their strategies without being overly constrained by financial burdens. In summary, tax breaks for small businesses are important as they not only provide immediate financial relief, more cash in your bank account, but also contribute to long-term economic growth. So let's talk about some specific examples of how small businesses use tax breaks. Technology startups. They may strategically take advantage of the research and development tax credits. The company can reduce its tax liability and allocate more resources to product development. A small manufacturing company may use tax planning to optimize its supply chain and production processes by taking advantage of tax incentives related to equipment depreciation or allocation-based tax breaks. The company can improve its overall cost structure, making its products more competitive. Small businesses in renewable energy companies may benefit from tax incentives and credits related to clean energy initiatives. By strategically planning their investments and projects, these companies can improve their financial position while contributing to sustainability goals, which the tax breaks are there for. To begin with, small real estate development firms may employ tax planning strategies related to property acquisitions, depreciation, and opportunity zones. So how are small businesses taxed? Sole proprietorships. They are not separate legal entities from their owner. All businesses' income and expenses are reported on the owner's personal tax return, Form 1040, Schedule C. The business itself does not pay income taxes. Remember, anytime you have made income during the year for any kind of work or selling a product online, you started a sole proprietorship and it must be reported. Many individuals get concerned, they don't want to report it, they don't think what's the point, but many times, specifically on the initial stages of a small business, reporting the income may produce a loss, and this will actually benefit the owner. If you use the tax laws wisely, many clients will benefit from deducting home office expenses, telephone expenses, internet expenses, and offset their W-2 employee income, which otherwise they would not have been able to do. Normally, a sole proprietor is taxed at their personal tax rate, and this will vary according to income. Partnerships. Similar to sole proprietorships, they are pass-through entities. The business itself does not pay income tax. Instead, profits and losses are passed through to the individual partners, who report them on the personal tax returns. Normally, a partnership prepares a Form 1065 and issues the partners a K-1 with all the information needed to report the income or losses. The income goes into the partner's personal tax return, and the tax tax rate is based on the individual according to income. S corporations are like partnerships. The business itself does not pay income taxes. Instead, again, income deductions credits flow through to the owner shareholder, who reports them on their individual tax return. The S corporation prepares an 1120S and issues the partner, the owners, a K1 with all the information needed to report income or losses. The income goes into the shareholder's personal tax return, and the tax rate is based on their individual income tax rate. C corporations, total separate legal entities. They have a flat rate of 21%. Corporation files 1120, and when dividends are paid to shareholders, on those dividends received, they also pay tax again. C corporations are subject to double taxation. What you're entitled to write off or not will depend specifically on your type of business. Let's discuss some specific tax credits for small businesses like the Research and Development Tax Credit. What is the Research and Development Credit? This typically applies to activities that involve developing new products, processes, or technologies, or improvements to existing ones. Qualifying activities often involve a systematic, scientific, or technological approach to solving technical challenges or uncertainties. While I can't provide real specific examples of individual companies that have received the Research and Development Tax Credit due to data limitations and privacy considerations, I can share a hypothetical example to illustrate how a small business might benefit from the Research and Development Credit. So let's hypothetically talk about XYZ Tech Solutions, a small software development company specializing in creating custom applications for clients. So in this particular year, Tech Solutions invested significant resources in research and development activities to better their software capabilities and create innovative solutions for its clients. They're doing normally what any company would do to improve their business. But now we look at laws to help us lower taxes, but we must understand how to qualify for the credit legally. So here's how basically they would qualify. The XYZ Tech Solutions focuses on improving the efficiency and functionality of its software products. The company development team engages in systematic testing, experimentation to overcome technical challenges and uncertainties in the software development process. They explore new algorithms and coding techniques to enhance the performance of their applications. What are going to be the eligible expenses? The wages and salaries of employees directly involved in the research and development. So remember, a good bookkeeping process and accountability of who's doing this is important. This company only did what any company would have normally done to better their business. Claiming the research and development credit, XYZ reduces its overall tax liability by freeing up additional capital to further reinvest in more research and development. The credit provides for a financial incentive for the company to continue innovating, staying competitive, and contributing to the financial growth of the industry. The Work Opportunity Tax Credit is a credit to encourage employers to hire individuals from certain target groups who face barriers to employment. The purpose of this credit is to stimulate the hiring of individuals who may have difficulty finding jobs due to various challenges, economic disadvantages, disability status, being veterans, individuals receiving supplemental nutrition assistance program benefits, long-term family assistant recipients, qualified ex-felons, designated community residents, vocational rehabilitation referrals, summer youth employees, and supplemental security income recipients. The tax credit amount varies depending on the target group and the number of hours the employee works. Employers can earn a tax credit equal to a percentage of the qualified employee's first-year wages up to a specified maximum. In general, the Work Opportunity Tax Credit is equal to 40% up to $6,000 of wages paid to or incurred on behalf of an individual who is in their first year of employment. The Small Business Healthcare Tax Credit is to help small businesses and tax-exempt organizations provide health insurance coverage to their employees. This credit was established as part of the Affordable Care Act to make make it more affordable for small employers to offer health insurance and promote well-being. To be eligible for the credit, a small business or tax-exempt organization must have fewer than 25 full-time equivalent employees and pay average of $56,000 or less. And the employer must also contribute at least 50% of the employee premium cost. So not only you're writing off the expense as an expense, now you qualify for this credit that offsets your tax liability. The maximum credit is 50% of premium costs for small businesses and 35% for tax-exempt organizations. The small business healthcare tax credit is available for 2 consecutive tax years, and employers can claim it in after tax year 2014 or later. To be eligible for the credit, small businesses must generally purchase healthcare insurance for employees through the Small Business Health Options Program, normally referred to as the Marketplace. Let's talk about expense deductions for small businesses. Section 179 depreciation is a really good one. That allows businesses to deduct the cost of certain qualifying property as an expense rather than depreciating it over time. The purpose of Section 179 is to encourage business investment in capital assets by providing an immediate tax benefit. So basically, instead of having a depreciation amount of $500 in one particular year, for, let's say, a computer you bought, now you get a complete write-off for the total cost of the computer, $5,000. Most business equipment, machinery equipment, and certain vehicles qualify for this write-off, as like anything else is subject to limitations depending on your specific type of business. Most types of businesses, including sole proprietorships, partnerships, and corporations, can take advantage of the Section 179 deduction. The deduction is intended to benefit businesses of all sizes, subject to certain limitations. For 2023, you can expense up to $1.1 million of eligible property. Property contained and or attached to a building, such as refrigerators, grocery store counters, office equipment, printing presses, testing equipment, signs, gasoline storage tanks, pumps at retail service stations, livestock, including horses, cattle, hogs. Additionally, in certain cases, Section 179 can be used for improvements to non-residential property, such as roofs, heating, ventilation, air conditioning systems. Remember, you may take Section 179 if you did not pay in full during the year, but you must use it in the year that it was acquired. The purpose of Section 179 is to stimulate business investments by providing an upfront tax incentive for the acquisition of capital assets, such as business equipment, business furniture, and any type of capital asset needed by a small business. By allowing businesses to deduct the full cost of qualifying property in the year of purchase, Section 179 aims to improve cash flow for businesses and encourage them to invest in assets that contribute to growth and productivity. It is essential for businesses to be aware of the specific rules and limitations of Section 179. The home office deduction, often not used and sometimes misused. So let's discuss how this deduction works. This deduction allows individuals and business owners to deduct certain expenses associated with the business use of their home. This deduction is available to self-employed individuals, independent contractors, and small business owners who use part of their home regularly and exclusively for business purposes. This can include a designated room or a portion of a room used as an office. This activity goes on a daily basis for most business owners, and many of them do not deduct this because they have another office outside of their home. Many business owners lose expenses that could be written off based on the percentage of use of the home. These expenses include a portion of mortgage interest, rent, property taxes, utilities, homeowners insurance, and maintenance costs. Depreciation of the home itself may also be a deductible expense. For small business taxpayers who are claiming the home office deduction, they should maintain a detailed record and documenting the expenses to support what the business used the home for, including receipts of all these eligible expenses and a description and how the home is used for the business. Take pictures. Be clear on what areas are being used, specifically if you're storing business goods for resale. So remember, if you have an outside office, you're eligible to use the home office deduction as a primary administrative office. Everything that you do to do your work at home for your business is fully deductible. Be sure to keep detailed records of what you have done and why, because it is essential for business and individuals to carefully adhere to the rules and requirements set forth by the Internal Revenue Service when claiming the home office deduction. The Qualified Business Income Deduction, normally referred to as QBI, is designed to provide tax relief for certain pass-through businesses, including sole proprietorships, partnerships, corporations, limited liability companies. It allows mainly for small business owners to deduct up to 20% of their qualified business income on their taxes. In general, taxable income in 2023 must be under $182,100 for single filers and $364,200 for joint filers to be able to qualify. Remember to tax plan to maximize the QBI deduction. You may do this by evaluating your business structure. So proprietorships and partnerships may have an advantage over others, mainly because these entities cannot pay wages to the owners. Income is not considered wages for purposes of the QBI, where they are if you are an S corporation. Since most businesses elect to be S corporations, I'm going to give you a way that you can maximize your QBI deduction. Let's assume that your business income is $800,000. You take a reasonable salary of $90,000. Unfortunately, this high income puts you over the QBI deduction. So instead, we are going to use the 50% of wages paid for the QBI deduction, which is limited in this case to $45,000. To maximize the QBI deduction rule, to determine an optimal salary, the salary should be 2/7 of the total business income, or $228,571, resulting in a QBI deduction of $114,000, which is 50% of the 2/7 rule. Keep in mind that tax planning should be tailored to your individual circumstances. Strategies that work for one business may not be suitable for another. This also shows you that depending on your income, you will have to make different adjustments. Remember about record keeping. Make sure you have one bank account for business purposes only, a credit card to be used for business purposes only. Maintain a minimum of 5 to 7 years of records of all expenses incurred during the year. And last but not least, it is imperative that a professional advice is sought after for implementing effective tax strategies and ensuring compliance with the current laws. So I'm curious, which of these deductions or credits do you plan on using in your business? Be sure to let me know in the comments below. My personal one is Section 179. I have been able to save clients thousands of dollars over the years. If you don't already know me, my name is Sonia Narvaez. I am a licensed CPA and wealth building strategist with over 25 years experience. If you have any business-related tax deduction or tax credit questions and would like a virtual online complimentary consultation by a member of my team, simply click the scheduling link in the description below and pick the time that works best for you. We would love to meet and help you. Lastly, be sure to like and subscribe to get more content just like this. By doing this, you will help other people discover our content. The more you help us grow this channel, the more free content we can provide to you. Until next time, have a great day, and I look forward to seeing you soon.